Good afternoon, and thank you for giving me the opportunity to present to you my findings on the investment recommendation in the quick service restaurant industry. Quick introduction as to what quick service restaurants or QSRs are. Obviously, these are your fast foods, your quick snack places, coffee shops, the places that you drive through and get a quick bite. Current conditions, obviously, it's a very large market. There's plenty of opportunity, but also a lot of competition. Some of the considerations that we have to take into account are the current conditions with the pandemic and how that affects things like a dine-in service and also the ability to have so many people within your location at a time. And the last thing is that any kind of restaurant venture is usually difficult to start as it does take a while to become profitable, and we have to make sure that you're able to survive those first difficult years. Um, Looking at your current investments, you currently have stock investments, real estate, and your construction business. So obviously, we want to keep in mind that those are what you're familiar with, those are what you've done in the past, and this is going to be a new venture for you. But there's going to be a lot of similarities where you're going to be able to apply your current knowledge and current experience to this new venture. You've got a few options. We can open a whole new location, completely different standalone franchised business. We can purchase an existing franchise as option number two. So you can find someone who's looking to retire or sell and purchase their existing built out location. Or you can open a standalone quick service restaurant. You can create your own brand, if you will, and go that way. Obviously, that'll be a lot more difficult. For the purposes of our report today, we looked at Quick Service Restaurant Magazine's top 50. They compile this list each year. We looked at the 2020 report, which uses the 2019 numbers, and then we looked at the 2019 report, which uses the 2018 numbers to be able to compare the year-over-year figures as far as sales and also change in location units. And we did only look at the franchise units. We did not look at the company-owned units because you'd be looking to do a franchise. So sales analysis of prior year sales. We see that McDonald's came in with the largest at a little over 40 billion. Starbucks, was next with 21 billion. Then Chick-fil-A, which of course is a private company, at 11 billion. Taco Bell with 11 billion, which is part of the Yum brands, as with Pizza Hut. Of course, the top five movers as far as like on the upward trend are McDonald's, Starbucks, Chick-fil-A, Taco Bell, and Burger King. And then the bottom five, as far as trending downwards, are going to be Subway, Pizza Hut, Papa John's, Papa Murphy's, and Church's Chicken. Upon further analysis on the sales, we did notice the growth year over year or lack thereof, with McDonald's and Starbucks growing the most, and of course Subway actually losing in sales for the year 2019. Last piece of the sales analysis, comparing those overall sales and the sales growth. You notice that Starbucks had the highest overall sales and the highest amount of sales growth. And Subway, while having a respectable amount of sales, did have the lowest sales growth and the largest loss of almost $500 million as far as a change from the previous year to 2019. Each of the companies that were public, we were able to take a look at some of the data this year just to give you an idea of some of the stock details, kind of where they're valued with their stock prices. Looking at McDonald's and then of course Starbucks, same kind of thing. With the pandemic, everybody's had a bit of a rough go of things, so nothing necessarily too surprising there. Taco Bell, which is part of Yum Brands, as you can see here, overall from the current 1 year mark, and not a huge drop, but still significant enough. Looking at Burger King, which is part of a bigger conglomerate of Restaurant Brands International. They own several different franchises. So while Burger King itself may be nice and strong, the company as a whole is overvalued, and that could be because of some of the other investments that they've made. Pizza Hut, of course, is another one of the Yum brands, so its information is identical to that of Taco Bell. Papa John's was the surprising one. Papa John's is one of our losers for the overall time, but they had a stock increase that was very sizable. We'll take a look at that here in just a minute, but you can see here they're the only one out of all of the options that actually had a green showing as far as showing that they ended the year higher than they began it. Trended segment analysis, we see the two biggest segments as far as, growth and sales is going to be, the burger segment and the snack segment. Snack, of course, being Starbucks there, and the burger being really bolstered up by McDonald's. Then, of course, you can see Burger King in there with the burger segment. Then, of course, chicken kind of in the middle, splitting the difference there. And then global pizza. Pizza's our biggest loser as far as a segment, in the fact that we had three different pizza restaurants that were on this list on the bottom side of the scale. Locations. So this is the analysis of the number of locations, both total and the number that were added or lost in a year. Subway by far has the largest number of locations, but they also closed almost 1,000 locations, last year. That's a little troubling because that tells us that those are markets where either A, they were underperforming, and so they probably should have never had a restaurant there in the first place, or they, could just be affected by the pandemic. Either way, that puts up several red flags as far as investment options. McDonald's had a strong overall number of the locations with a modest increase, a modest decrease of 66 locations. That could be for a number of factors. Just normal turnover. It could be, closing of one location and opening of a new one, or they could have consolidated. Also with different natural disasters and everything, and with the pandemic, it's tough to say exactly what is affecting all of that. Then, of course, going on down the line, looking at, Papa John's with 52 closed. The biggest gainer was Starbucks at 216. So that shows that there's a lot of new markets and a good potential for further growth in that segment. Quick look at the stock price change. Don't necessarily want to go into the decision of which company to become a franchisee of based solely off of the stock price, because as we can see, Papa John's had a very nice $53 increase. That's almost a doubling of the original stock price. And McDonald's had a loss of 11.44, but the two of those, and even then Starbucks had a loss of 18.15 on the year. Now this, of course, was all pre-pandemic, and so therefore there have been some changes going forward to now. But it just gives you the idea that these are companies that obviously are actively traded, and they are, constantly, having more money invested into them by new investors and having money taken out by investors who are trying to sell out. Some of the deciding factors on the recommendation today is the business sustainable? Is it a segment that has been around for a while and has that staying power? Brand recognition, it's like how readily do people understand the brand and how readily do people want to patronize the brand? Growth potential, obviously we want to make sure that you're going into something that has further growth potential beyond your one restaurant. You may want to open a second location down the road. We also want to make sure that the brand of the segment has the ability to sustain your growth. And of course, market compatibility. Is the particular company that we're looking at compatible with the market we're looking to put it in? If it's not, then we're going to have a very difficult uphill battle for you, and I don't want to see that happen. So with that being said, the recommendation would be to open the quick service restaurant of Starbucks. The reason being is because Starbucks is one of those brands that is everywhere. The location would be in Southern California because it's very friendly to trendy coffee locations. Market saturation. Starbucks is one of those companies that tends to be able to be on every corner, and the businesses do well and people patronize them. Weather conditions and concerns obviously would be in Southern California, but it's beautiful there, so no major concerns with that. Geographical impact, again, Southern California, no big concerns there. Sanitation issues, being in California, their standards are very high as far as health and safety, so we should be really good to go with that as well. Final conclusion, find a location, secure your funding, start your build out, do a soft open, and then a grand opening. Thank you and have a great day.